live from the Middle East, another edition of The Officials, directly from Dubai. In our area, many things are happening, and The Officials tells you in situ the latest. So thank you very much for supporting us. Watch our podcast, and we'll share many insights with you. Thank you. Okay, folks, this is another edition of The Officials. And we have people in Dubai and in London sharing with you what we have learned in these past few days, sharing all the greatest events happening. To start with, the most important thing has been the attack of Iran against Israel. And really, as a sign of respect, I'll do this. I was just trying to look the part in the Middle East. The attack against Israel didn't catch anyone by surprise. Again, Iran telegraphed the action. It telegraphed even the locations it would attack. Talking to the people in this area, they feel very strongly that Iran was very measured in their action, that they didn't go after civilians. They went after military installations, and they didn't shoot rockets willy-nilly, but really were well-directed, well-aimed. And they feel in this area that Israel is the wild card, that the killing of civilians is too much, and that they don't aim carefully. We all saw the videos and how it penetrated the Israeli defenses, the so-called Iron Dome, which by now is being known as the Iron Colander because it let through so many missiles. The question in people's heads right now is what's going to happen next. So let's look a little bit about the price. The oil market before the attack was flirting again with the upper 60s. So the market had again gone to the 6 handle. And then with the news of the impending attack, it rapidly rose towards the mid 70s. One of the issues or notations I was sharing with people in Fujairah, where I attended a large conference held by Gulf Intelligence, was that despite the attack, the oil price only went up roughly $5. And as the situation unfolds, we could see a closure of the Strait of Hormuz and also the strait between Yemen and Africa, which in the English translation has a really sad name. It's called the Strait of Tears, the Strait of Grief, the Strait of Lamentation would be the actual translation of that name. And I think the area has too many tears, too much grief, too much lamentation, and hopefully it doesn't happen again. What I would like to do right now is to introduce my two colleagues, Ed and Will, who work with me in The Officials, and they're going to give you a little bit of a sum up of what happened with the price action in the past couple of days. Back to you, Will, if you could give us a sum up of what happened in the market.
Thank you, Jorge. Yeah, so as Jorge explained, we had a very, very strong price reaction to the strike, and we saw flat price Brent rally all the way up to over $76, and then it kind of hovered around that range for quite some time as markets were trying to assess what the next action would be from Israel if a retaliation was going to come. And then we got the release of the EIAs, as well as some news from OPEC, which I'm sure Ed will talk about in a little minute. And flat price then descended pretty quickly following that news. So the EIA crude stocks showed a kind of a 3.9 million barrel build. And this had a bit of a bearish response on price action, would you say, Ed?
Yeah, definitely. We saw yesterday afternoon there was a significant drop off in prices from their high level, back down towards kind of 73 level. So really the macro picture and the kind of the demand picture hasn't really changed. We're just seeing these events in the Middle East have really gone head to head with the weak economic data we've been seeing for the last few months.
Exactly, and then following that, this morning we saw further strength through into the afternoon, as news circulated about a retaliatory strike from Israel in Lebanon, and potential escalations. Whether the US would escalate further, we think this is unlikely. Further US escalation would be dangerous ahead of the election. I think it'd be pretty politically unpopular. But yeah, so we've seen further strength, and now we're trading around the $75 handle still.
Please let's focus on that issue that the market went up $5-6 at the most when two of the most important straits to move oil in the world are under threat of closure. And the market essentially did not react. I mean, to go up by less than 10%, while the flow of oil from the Middle East is under threat is very little. I spoke to the Saudis, I spoke to the Emiratis in the conference, and a very senior individual I know at Aramco was telling me, well, the reason is because it's really bad. The market is really bad, he said. We cannot hide it anymore. There's too much supply. And this was the feature issue at the conference. While the missiles were flying overhead in their way to, well, not over our head, but in other areas overhead towards Israel, the thought in everybody's mind there was still bearish, that the market is low. And fingers started to be pointed out to many countries, individuals, ministers. And the most of the fingers were aimed at Kazakhstan, at Algeria, at the Russians, at the poor Iraqis who, of course, never uh, toe the line on the OPEC guidelines. They always overproduce. They produce as much as they can, but people were pointing at them, while in fact, and I'm a guest here in the Emirates, the perhaps the largest over the level producer is the UAE. I have interviewed many people in groups and one to one, and they're telling me that the Emirates, the UAE, ADNOC, is producing between 400 and 600 extra thousand barrels per day. And in one shocking comment, one person even said it's closer to 1 million barrels a day. We haven't really unearthed the actual number, but I would say if we have it to the 500, which is the common number, that really throws the balances out. And we also notice in the past few months, even Saudi Aramco is increasing the supply into the east. So we're going to be looking at the nominations that should come in the next 5 days, 5-7 days out of these countries and see what they're doing, because there's actually too much supply at a time that the markets really are not growing. We have been bearish on China for months. That point of view has been validated by data and even by the actions of the Chinese government to rescue their economy with the release of lower interest rates and trying to pump up the volume on stocks and also on housing. But there's also so many other areas of weakness. One of them, of course, is the neighboring areas to China, because they depend on a healthy, big partner to be requiring supplies from them, iron ore and other metals from Australia, as well as semi-finished goods from Vietnam or Korea or Japan. So when China reduced interest rates and tried to spark life into stock markets, uh, the stock market in China reacted positively, but also in Japan, in Korea, in Singapore, in Hong Kong, in all that area, the stock markets went up. We all need each other, and clearly a healthy China is good for that region and even for the world. Germany is a huge sort of worry for us right now because they seem to be heading into a terrible Q4. And as other people were noting to me in the discussions, France is about to fall out of bed because the stimulus from the Olympics is now behind the country and the real economics are coming back in. So it is clear that we need more stimulus, but then this will have inflation. I wanted to give it back to Will and Ed to do a sum up of what they see on the industrial indicators and PMIs and all that stuff, unemployment, etc., happening in Europe and the US. Will and Ed, can you give us a summary again?
Yeah, of course. So yeah, it's been more of the same really. Systemic weakness really throughout Europe, especially on the PMI front. As you said, in France, we've had the fallout from the Olympics. So the Olympics boosted a lot of sentiment. So services PMIs went into contraction again for September in France and much of Europe, which had been propping up the composite indicator for quite some time. Manufacturing is still very, very poor across Europe. Germany's manufacturing PMI is around 40, so declining at historically some of the steepest levels we've seen. And interestingly, in the US, we're seeing a slight shift. So ADP employment data printed a little bit more positively than markets had expected. And we saw gains across hospitality and services. But we also saw strong gains in construction. And we've seen, as Ed discussed last podcast, we've seen mortgage rates really start to come down as the Fed has been cutting aggressively. And this has provided a little bit of relief for construction in the US, which for a long time had been pretty dire. Housing starts have been very, very weak. In fact, a lot of economists look at housing starts as a leading indicator for recession, and they've been calling the recession card. But now we're starting to see a bit of a resurgence in construction, which is obviously very good for diesel, petchems. But we're also seeing strong services in the US as mortgage rates come down. Consumers are able to spend more. And they're more likely to go out to a restaurant or go buy beers or what have you. And it's really good for the service sector as well. And that could also be good for gasoline. So we're seeing a little bit of a divergence, aren't we, across Europe and the US?
Yeah, very much so. I'd say that Europe is looking in a much more fragile position, particularly in the industrial front. The industrial data we're getting from Germany and from France is really terrible. And when Europe is relying on Spain for some positive industrial data, that tells you that it's really not a good picture for the whole continent. Whereas I think, yeah, the US is, I think, maneuvering towards a fairly soft landing from the interest rate cutting. So I think they've managed that quite well. But anything can happen. We could get a terrible NFP print tomorrow, and then we'd all be talking much more negatively again. So it's very much in the balance, I'd say.
Yeah.
Thank you very much. And now let me close up the session with some comments about markets. Another issue that came up in the conversations was the overperformance of the Dubai benchmark. The traders were essentially complaining that Dubai had been so strong in the past couple of months. And as you have seen last month, Vitol was buying a lot of Dubai. This month at the beginning was Mitsui, and then some other companies start switching around. But it was very remarkable to them, and they were surprised because the demand from China at the consumer level was declining. Gasoline is not performing, diesel is not performing, yet the crude to make these products was way overperforming. And only in recent days, it starts to behave more in line with the fundamentals. And of course, the people even that trade and produce it and sell it like to see a reflection of the market in the structure and the price behavior. the other issue that came up is while we were in the conference, a story came out by Reuters addressing the, I guess, misbehavior in data Brent. We have put it on LinkedIn. I suggest you read the story and you make up your own mind. In the article, it mentioned that Platts had stated that no complaints had been made regarding data Brent. We were a little surprised because we have seen text messages of people that have complained and they have shared with us. It also came up with a conversation today with another big refining buyer that shared with us the same thoughts. They said we have called them several times and there is no reaction. So I think in all this issue of benchmarking and in reporting, of course, we think honesty is extremely critical and one is to be straight in everything one does. So with that, I thank you very much for listening to the officials until the next version, hopefully from London. Take care. Thank you.